Welcome to the Liberty Call. Welcome, everybody. Welcome to the best dams. I was going to say sports. I've watched too many sports shows. The best damn financial news show that money can't buy. So if it's your first time watching, slap all those subscribe buttons. I'd greatly appreciate it. Give me some thumbs up, likes, shares, all that good stuff. And not a terrible day in the market, but definitely not a good day. And there was obviously some news that came out that seems to have made all the people who want interest rates to go back down, making them very so sad. Oh, why you keep raising interest rates? You're making my valuations of my, tech companies that have really no real value. You're hurting those companies. So, yeah, it really makes my heart break, right here. So, all right, let's go ahead and dive into the indexes for the day. The Dow Jones was down 0.24, closed at 32,653. I mean, it was only down, 80 points, so it's not the end of the world. S&P 500 down 0.41, closed at 3856. NASDAQ was down 0.89, closed at 10,890. Small caps were up 0.32%. The VIX pulled back 0.27, a little odd since the S&P was down also. The VIX is currently sitting at 2581. Other Americas, Canada was up 0.47, Brazil was up 0.77, Mexico up 1.75. Let's take that big leap across the Atlantic. Germany was up 0.64, UK was up 1.29, France up 0.98, Euro Stoxx was up 0.93, Netherlands up 0.4, Spain up 0.53, Italy up 0.63. One of the loan down indicators in Europe, Switzerland down 0.41, Portugal up 1.92. Headed a little further east, the Russian indexes, the MOEX was up 0.36, the RTSI was up 0.59, and headed into the overnights in Asia, Japan was up 0.33, Australia up 1.65, New Zealand dipped 0.2. Let's see, the Chinese markets appear to be all green. The Shanghai was up 2.62, the SCSE component up 3.24, China A50 was up 4.12, DJ Shanghai up 2.91, and the Hang Seng up 5.23. I mean, those are some strong numbers, but and the Taiwan weighted was up 0.68. But the the Chinese markets had been waning over the last from last week into this week, so not surprising that you might see a bit of a bounce back day. We'll see if that trend continues long term. Boy, I am due for a trim. It is getting shaggy. So apologize for my my beardliness being so out of control today. All right. It also doesn't help that I sit and twist it all day long. I definitely got my grandfather's obsessive compulsive disorder. So miss you, Grandpa. All right, let's dive into today's market recap. S&P 500 stumbles on worry strong data to keep the Fed leaning hawkish. Remember where I said that the financial journalists are just boo-boo-hoo and tears everywhere because they're not gonna lower interest rates and print more money out of thin air. Oh my God. Let's dive into this. The S&P 500 slipped Tuesday under pressure from tech after better than expected data showing underlying strength in the labor market weighed on hopes for a less hawkish Federal Reserve. Again, read that. I mean, let's read that again. Under pressure from tech after better than expected data showing underlying strength in the labor market weighed on hopes for a less hawkish Fed. So they're upset that the labor market is actually doing fairly well, even though things are more expensive. Labor costs are going up, and that's putting a big strain on, small and big businesses alike. So again, these people, we saw this late last year. When the Fed had already telegraphed what their plan was for 2022 for raising rates, they were already talking about when they're going to start lowering rates. And it's like, really, are you serious? Let's deal with the problem right in front of us before we start, counting our chickens, well before they even have hatched. It's just, it drives me up the wall. Again, that's why we're in these situations right now. It's because you got all these people who all they care about themselves. They don't care about the bigger picture. And, and now, we created all this money out of thin air 2 years ago. And, you increase the money supply by 40%. What do you expect is going to happen? Everything is going to be more expensive. And the last article we're going to cover, they're going to talk about, the mistakes that the Fed made and why, inflation is so high. But they kind of missed the big picture altogether, it seems like. All right, diving back in. Apple Inc. Led the weakness in big tech as Treasury yields moved off session lows after the data showing better than expected manufacturing activity and job openings cooled bets somewhat on a slower pace of rate hikes. Job openings increased to 10.7 million, confounding expectations for a fall to 10 million. Quote, today's data suggests that hopes for a Fed pivot may have been premature, end quote, Jeffrey said in a note. The FOMC kicked off its two-day meeting and is expected to raise rates by 0.75% on Wednesday. Still, there are some who suggest that Fed Chairman Jerome Powell will likely point to slowing growth as a factor that the Fed is monitoring, but the Fed chief will be wary of leaning too dovish to signal that a pivot is forthcoming. Again, they are hell-bent on pivoting to lower rates and money printing and inflation, which has got us into this exact situation. You know, if we had sound money, if we were actually attached to a gold exchange standard, we would not be in this situation right now. I mean, you could probably still buy a hamburger for under $1 if we hadn't, inflated the currency so dramatically, over my lifetime. And I was born in 1974. And, since the creation of the Federal Reserve in 1913, we have devalued the buying power of our currency so dramatically, and people just can't get it. They think that, money is just magic and it just creates out of nowhere. No, it's a store of value that and money is supposed to be the exchange of that store of value into something else. Used to it was gold and silver, but today it's nothing. All right. Quote, Powell will move off of the Jackson Hole sounding rhetoric and potentially say we're going to slow the path of rate hike increases, but we're going to keep the rates at the same levels for a while, end quote. Chief strategist at Spouting Rock Asset Management, Reese Williams, told Investing.com Yassine Ibrahim in an interview on Tuesday. Quote, I think he will probably also emphasize we're not going to have a V-shaped turn in the Fed policy, end quote, Reese said. On the earnings front, meanwhile, Uber Technologies jumped more than 12% after its stronger than fourth quarter guidance overshadowed a probably wider than expected loss. Somebody needs to proofread their work here. Pfizer also delivered better than expected guidance following third quarter results that topped Wall Street estimates despite a slump in COVID-19 vaccine sales. In the quarter, its shares were up more than 3%. Yeah, people aren't getting those vaccines. I can't imagine that people are going to continue, especially with all the negative data that has come out about them, that, they don't stop the spread. I'm iffy if they even do anything. For those who actually do contract it, I still at this point have never had it, so I don't know how that's possible. But maybe I'm just one of those lucky folks. SoFi Technologies surged more than 5% after delivering better than feared quarterly results and raising its full year guidance despite impact extensions of the student loan moratorium. In other news, China-related stocks were in the ascendancy on reports that China might be about to lift some of its COVID-related restrictions across the country. Alibaba Group Holdings, JD.com, and Baidu were up more than 3%. So, all right. Sorry, I rambled a little in between there, giving my own little commentary. I do that sometimes. I get a little aggravated with the stupidity out there. All right. Next up, U.S. job openings bounced sharply in September, but ISM manufacturing PMI falls to 50.2, so that may not be good news. The last batch of U.S. economic data before the Federal Reserve's latest policy meeting showed much of the economy is still in surprisingly rude health, casting doubt over the ability of the central bank to moderate the pace of its monetary tightening. The Labor Department's monthly survey of job openings and labor turnover showed a sharp rebound in vacancies in September after an August drop that many thought would herald a broader slowdown. Vacancies rose by nearly 500,000 to 10.717 million from an August figure that itself revised up to 10.28 million. They remain in a downward trend, stretching back to the first quarter of the year even so. At the same time, a closely watched gauge of business activity also turned out a little stronger than expected. The ISM's manufacturing purchasers managers index fell to 50.2 from 50.9, slightly higher than the consensus for a 50, the level that typically divides expansion from contraction. The stronger than expected numbers dented hopes that the Fed will signal an early end to interest rate hikes when it announces the results of its latest meeting on Wednesday. The dollar rose nearly 0.5% on the news to stand at 111.145, down only 0.2% on the day. The yield on the benchmark 2-year note, which is sensitive to expectations of Fed interest rates, reversed its downward drifting 10 basis points to 4.51, unchanged on the day. However, analysts warned that the headline vacancies numbers may be misleading and focused instead on a steady decline in numbers of people quitting their job. This fell in September to 4.06 million, the lowest since the second quarter of last year, although it's still nearly 18% above the level immediately prior to the pandemic, according to Glassdoor chief Daniel Zhao. Skanda Amarnath, sorry if I butchered your name, dude, executive director of Employ America, argued that, quote, quits are the signal amidst the job opening noise, end quote, and pointed out that they have never retraced some 2/3 of gains they made during the pandemic. The quit rate is also important for its influence on wage growth, with most data showing that those who leave for another job typically get a much bigger pay raise than those who stay where they are. Falling quits thus represents weakening wage inflation pressure. The JOLT survey is the first of a handful of big numbers from the Labor Department due this week. It's also most backward-looking, covering only the period through September. The ADP and government labor reports on Wednesday and Friday, by contrast, will cover the month through mid-October, while jobless claims data due on Thursday will be even fresher. The biggest increase in vacancies were in the hotel and restaurant trade and in health and social care. These two categories accounted for over half of the total increase. On the negative side, wholesale openings fell by 100,000 and those in finance and insurance fell by over 80,000. So again, I mean, if you read this, you can see the where they're trying to cheer things on, and it just doesn't make any sense. All right, last article. Why did inflation surge to a 40-year high? Here are 4 causes of the worst monetary policy mistakes in years. Again, I'm happy that these journalists are pointing these things out, that the mistakes of these supposedly brilliant people who run the government and run our monetary system, but they're missing the big picture, and we'll see if you see it too. All right, the Federal Reserve has made 2 major policy blunders in the last 25 years. The first being unaware that the foundation of the U.S. banking system had eroded away by complex mortgage securities that carried high credit ratings, but turned out to be toxic during a broad housing turndown. The resulting meltdown in valuations caused the global financial crisis in 2008 that hobbled the United States economy for years. Well, I'd actually point back to the legislators who changed the laws which broke the Chinese firewall between commercial and retail banking, and then you then had these banks which were cross pollinating across their all of their banking streams. And also just allowing, the industry. I mean, not that the government should be regulating these businesses anyways, but they allow these banks to put out these garbage mortgages through their government programs. And then when they get slapped in the face later on because they made a bad investment into people who had no means to repay these loans, then they're like, oh my God, I can't believe what happened. It's like, again, they're always caught off guard. I couldn't believe what happened. More recently, a misreading of the strength of the labor market and the persistence of price shocks sparked by the pandemic led to the highest inflation rate in 40 years. And the final chapter of this saga is still being written. The policy era paved the way to make 2022 the worst year in financial markets, arguably, since the 1930s. Both stocks and bonds have plummeted, and the Federal Reserve Chairman Jay Powell is at the center of the financial turmoil, landing him on the Market Watch 50 list of most influential people in markets. Critics have pounced on the Fed Powell's insistence that rising inflation was transitory, and that's in quotes, and would quickly dissipate once the economy reopened more fully, and has been called, quote, probably the worst inflation call in Fed history, end quote, by Mohamed El-Erian, chief economist for Allianz, or chief economic advisor for Allianz. The economist Stephen Roach has compared Powell to former Fed Chair Arthur Burns, whose indecisiveness under intense political pressure led to the crushing inflation in the 1970s. As recently as March 2022, when the Labor Department was reporting a 7.9 annual raise in consumer prices, Powell and the Fed were just wrapping up their injections of liquidity into financial markets. Again, these people cause these problems. And, now you're finally pointing it out. Boy, very brave of you. How Powell, who is not a trained economist, is ultimately remembered will depend on whether he's able to tame inflation without driving the U.S. into a deep recession. It still could all end relatively well, but the debate about what signs the U.S. central bank ignored will be studied and debated for years to come. All right. For now, outside experts are debating the causes which led to the biggest policy mistake. Some Fed officials, including Powell, have started to chime in. Following are the four underlying causes of the initial policy error that emerged in interviews with experts. They include the Fed's new policy framework, Powell's distrust of forecasts, unintended consequences of some forward guidance the Fed gave markets in 2020, and the nature of the pandemic's perfect economic storm. A new policy framework unveiled in August of 2020. In August of 2020, as the nation was emerging from COVID-19 lockdowns, Jay Powell's Federal Reserve announced a monumental shift. For more than a year prior to the pandemic, the Fed had been working on a new policy framework, and the pandemic wasn't about to stop the U.S. central bank from implementing what it had been putting together. Quote, the economy is always evolving, end quote, Powell said. The Fed's interest rate committee's strategy for achieving its goals must adapt to meet the new challenges that arise. Powell was not referring to the extraordinary economic events associated with the early days of the pandemic. Instead, the policy shift had been designed for a new world of low inflation, a reality that had dragged on for some 2 decades. Well, we were still having, 2%-ish inflation, which is still inflation. I mean, yeah, it takes 35 years to double the cost of something, but it's still inflation, and there's really no reason why we should have it. Let's see. Quote, the framework document that came after 20 years of being very difficult to get inflation to 2%. And so, unfortunately, the framework assumed that type of environment was going to persist, end quote, said former Boston Fed President Eric Rosengren in an interview. With the new playbook, the Fed essentially decided it would not raise interest rates at the first sign of a strong labor market, which had become the cardinal rule after the bout of high inflation in the 1980s. Instead, the Fed would be more patient about using the blunt tool of raising interest rates to increase borrowing costs for businesses and consumers to tamp down inflation. This upended the Fed's longstanding resilience on the Phillips curve models that say that tight labor markets and wage pressures are the main driver of inflation. No, actually, it's monetary supply. He's so close. I mean, these guys are this close to being right to where the answer is. The change was greeted with skepticism by some experts, such as Stephen Stanley, chief economist at Amherst Pierpoint Stanley, a U.S. fixed income broker. In an email to clients after the new framework was announced, Stanley said that, in effect, Powell had concluded that inflation was simply a mystery to the Fed, and since it has no ability to accurately predict inflation, it must simply react to it after the results are in. Quote, that might work out okay, but if inflation occurs with, quote, long and variable lags, end quote, as Milton Friedman famously said, then a reactive policy will always be behind the curve and exercise in futility, end quote, Stanley said. Quote, by the time the Fed realized the policy was too easy, the inflation genie will be out of the bottle. By the way, this is exactly the approach the Fed got the Fed in so much trouble in the late 60s and 1970s, end quote. Today, both Rosengren and Stanley believe the new framework contributed to the current inflation outbreak. Quote, I think the framework actually did cause the committee to delay actions that it might have taken more aggressively under the previous framework, end quote, Rosengren said. And that's probably when last fall I was, yelling into this microphone to the 3 people who watch this on a regular basis and was saying this is a big mistake. And, it is. A distrust of forecasts. Lou Crandall, chief economist at Wrightson ICAP, a research firm that analyzes Federal Reserve operations, said that Powell and his Fed colleagues, like many economists, didn't keep up with the rapidly changing economic outlook. When confronted with high inflation, quote, they were determined not to overreact to what seemed like a special event, end quote, he said. Crandall said Powell, a lawyer by training who worked for years as a partner at Carlyle Group, a private equity firm, was very skeptical of economic models and forecasts. Quote, a career in private equity will make you a bit skeptical of forecasting, quote, Crandall said. This led the Powell Fed to shift to, quote, an outcome-based reaction function, end quote, from a prior reliance on forecasts. In other words, the Fed wanted to see the whites of their eyes of inflation rather than anticipating its presence over the horizon. Bill Nelson, a former top Fed staffer who is now chief economist at Bank Policy Institute, a lobbying firm for the biggest U.S. banks, is not a fan of using current levels to make policy. Yeah. A lobbying firm. Boy, those are the people I want to hear from. Quote, the Fed should be looking ahead, not looking around, end quote, Nelson said in a summer email to colleagues. Quote, it's the same as driving a car. For a smooth ride, you need to look ahead. If you just look at your immediate surroundings, you end up having to slam on your brakes or accelerating so fast that you later have to slam on the brakes. All right, next up, forward guidance turns into a straitjacket for the Fed. This mistake that nags at Fed officials is slightly different. It relates to two pieces of forward guidance provided to financial markets in 2020. In the immediate aftermath of the financial crisis of 2008, bond market participants started to anticipate that the Fed would soon raise interest rates. The Fed didn't want longer-term bond yields to rise, so it gave market guidance that it was not changing the course for a long time. This kept interest rates low. In the end, the Fed didn't raise its benchmark interest rate until 2016. So basically, we had low rates until the Trump presidency, and then they actually started lowering them at the end of 2019 because the market was getting ready to crash in 2020. COVID was just a good excuse to paper over everything. Since almost the onset of the pandemic, the Fed was buying $120 billion in treasuries and mortgage-backed securities each month to support the markets and the economy, as well as keep interest rates low. The Fed was buying, and how were they buying that? With money they printed out of thin air. They didn't actually have money sitting in their reserve. They don't have reserves. The Federal Reserve is neither federal nor has reserves. As part of its forward guidance, Powell and the Fed wanted to lay out the criteria to slow down and end the bond purchases, and also it would contemplate the first rate hike. The market understood from Powell and other Fed officials that ending bond purchases was a precondition to any rate hike for the market. As long as the Fed was buying assets, it was not going to raise rates. In the last cycle, the Fed waited 2 years before ending purchases and hiking rates. The rate hike guidance first came in September of 2020. The Fed said it wouldn't raise its benchmark rate from close to zero until labor market conditions have reached levels consistent with the Fed's interest rate committee's assessment of maximum employment and inflation had risen to 2% and is on track to moderately exceed 2% for some time, end quote. In December of 2020, the Fed followed up with forward guidance that it would keep buying bonds at $120 billion monthly pace until substantially further progress had been made toward the committee's maximum employment and price stability goals. While the Fed never defined substantial further progress, financial market participants took it as a clear sign that the Fed wouldn't even think about raising interest rates until 2022. This ended all the talk about tapering bond purchases for 6 months. Meanwhile, inflation pressures gathered steam. Quote, the economy evolved rapidly in 2021, end quote, Christopher Waller, a Fed governor, noted in a speech last year. Waller said it was an open question whether the guidance the Fed had issued was too restrictive and might not have allowed enough flexibility for Powell and the other 11 voting members of the Monetary Policy Setting Federal Open Market Committee. Asked about the forward guidance at a recent press conference, Powell said the Fed thought it needed to make a strong statement that it would get inflation back to 2%. Quote, I don't think that that has materially changed the situation, but I have to admit, I don't think it would do it again, or I would do it again, end quote, Powell said. He added that perhaps the lesson is to leave a little more flexibility in forward guidance. In the end, Powell said he was not sure it was a big deal. Quote, did it matter in the end? If you look at it, I really don't think it did. I'm not sure it would have mattered if we had been raising rates 3 months earlier, end quote. Well, it might have helped. Nevertheless, the Fed pivot too hard and stopped all the bond purchases only days before it raised benchmark interest rate in March this year. In addition to Powell, other Fed officials such as Cleveland Fed President Loretta Mester have said that forward guidance would have to be improved during the next economic cycle. The perfect storm. The kindest explanation for the Fed's error was the pandemic resulted in a perfect storm that no one could predict. Yeah, I could predict that if you increase the money supply by that much, you're going to have problems. Quote, the main issue was not seeing all the inflationary forces that come together. In fairness, this was a perfect storm. Every possible thing that could lead to inflation happened, end quote, said Mark Gertler, a professor of economics at NYU who has co-authored blah, blah, blah. The rapid economic recovery from the 2019 lockdowns led to a burst in demand fueled by government stimulus payments to consumers and businesses. Where did that government stimulus come from? Money printing. Exactly. But also complicated by supply chain disruptions Related to the pandemic, the war in Ukraine was another major factor that pushed oil prices up. And, quote, you can't blame the Fed for not foreseeing that, end quote, Gertler said. Meanwhile, the slow return to work, retirements and resignations from unpleasant work during the pandemic meant that labor market shortages pushed up wages. With the benefit of hindsight, Gertler said these forces make sense, but economists didn't foresee them ahead of time. The long history of low inflation in the decade before the pandemic further muddies the waters. The Fed and other central banks have been trying to and failing to push inflation rates to 2%. There were serious questions about whether the central banks could even create inflation because there had hardly been any inflation for 25 years. The expansionary fiscal and monetary policies coming out of the 2008 financial crisis had not generated a rise in consumer prices above the 2% target. They just didn't see this coming, Gertler said. Brian Bethune, an economics professor at Boston College, said that the National Bureau of Economic Research made a mistake when it formally called the 2-month downturn at the start of the pandemic, March-April 2020, a recession. He said the economy quickly recovered, yet the recession label led the Fed and Congress to pour on stimulus that wasn't needed. Well, that is the one person here that actually has mentioned that printing money was a mistake. All right. Finally got there. It took reading through this for like 10 minutes to actually get to the part where someone actually says the big problem. Printing too much money led to this problem. Number one, getting it back under control, raising rates is probably the best way to do it. We have a historical something to look at from the early 80s where Paul Volcker did that. Granted, he has his own problems. If you read through the history of the Federal Reserve and all the bailouts that they've done over the years. But anyways. All right. Sorry, went a little long. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. If you'd like to book a meeting, get your finances in order, plan for your retirement or whatever the hell you want to plan for, reach out to me, book a meeting, and we can get started. So hope everyone has a fantastic night, and I'll be back tomorrow. Bye.